Hello people, I'm Jim. In today's video, I'm going to talk to you about why you need to save money to invest right now. We all know we should save for the future, but I really think it's important to understand the cost of not investing. In real terms, your money is going down via inflation. Whereas if you invest, not only can you hedge against inflation, you can actually make money. I will also talk about three of the most important concepts when it comes to investing, which are timing the market, compounding, and long-term thinking. Finally, at the end of this video, I'll give you an overview on how you can invest into three different asset classes for your future. According to the Investopedia Affluent Millennial Survey, 46% of millennials surveyed say they aren't saving enough money, and 39% say they expect to be forced to work beyond retirement age. I hope by the end of this video, you can understand why it's so important to start saving money, regardless of how much money you earn. As millennials, we'll be looking at retirement age of our early 70s, so the idea of having to work longer than that is a bit of a stinker, when we all know we want to be down the bingo hall having a rave. So in case you've not guessed, I'm the guy on a night out who'll start talking about property, investments, pensions, ISAs, and stocks and shares.
Yeah, well, I'm investing. I'm like Warren Buffett.
In all seriousness though, I do believe it's really important to make sure you invest for your future. Life can be really unpredictable at times, so making sure you have investments which are growing over the long term will put you in a better financial position, which in my opinion gives you a lot more freedom when it comes to the choices you make. Not only this, but you do not want to spend the best years of your life working and getting to an age where you should be retiring and having to worry about how much money you've saved. Being a millennial myself, I know the daily struggle we all go through of wanting to buy avocado on toast and chai lattes from Starbucks. But if we can plan for our future and take some of this money and invest it, we can end up putting ourselves in a fairly secure financial situation where we have no stress about money and we do not have to rely on the government and other people to pay for our retirement. We all have a vision about what our life will look like one day. In my opinion, any dream like this is built upon a foundation of financial independence and having enough money saved and invested to make this dream a reality. For me, I would love to get to the stage where me and my girlfriend could spend the winter travelling around the world skiing. Having a clear picture about what your future looks like will help you when saving and investing feels tough. So much of personal finance starts with taking responsibility for our own futures. Ultimately in life, you are the only person you can 100% rely on, so it's important to have this mindset at all times, particularly with money. Sometimes people delay saving money until they start earning more. This is the wrong mentality in my opinion. Saving and investing is a habit you want to practice as much as possible, no matter the amount, as you're reinforcing good behaviours which will benefit you in the long term. Starting with £20 a month is a good start if you can't afford any more, but I guarantee once you get into the habit and the mindset of saving and investing for your future, you will start to add more money to it, and you'll be aware about how much more money you waste each month which could be spent on investing. Next up, I'm going to explain why you need to start making sure you're investing your money, as in real terms your money is losing value over time. This is due to a thing called inflation. Now inflation sounds more complicated than it is. All it means is generally over time the price of things go up. For example, the average cost of a pint of beer in 1990 was £1.20, whereas in 2020 it was £3.80. This is inflation at work. Currently in the UK, inflation is around 1.7% a year, with most savings accounts offering you 0.5% of interest. Although you earn 0.5% of interest, everything has gone up by 1.7%. So in real terms, the value of your money has gone down as you can afford to buy less stuff. Obviously, we do not want our money to go down over time. We want to make money, and the best way to do this is by investing into assets. Now the three ways to invest I'm going to talk about are stocks and shares, property, and crypto. But before I do, I think it's important to talk about the main three principles when it comes to investing. First up is the principle that time in the market beats timing the market. What does this mean? Well, timing the market involves picking the point where the market is at the bottom. This could be the housing market, for example, after 2008, or it could be the stock market. April 2020 was a good example of this. Now, it's easy for me to sit here and say when the dip was with the benefit of hindsight, but at the time, it's tough to know when the bottom of the market is, and you might always be waiting in case it drops even lower. On the flip side, time in the market involves being in the market for the long term. So this might be investing every single month over the course of 30 years. If you're always trying to time the market, you might always be waiting for another dip and miss out on all the potential gains you could get. Not only this, but by trying to time the market, there is a high likelihood that you will miss the best performing days simply because you are not in the market. This is not the case with time in the market, as regardless of the ups and downs, you are still buying in. It is always better being in the market than out of the market. And if you link that with another key investing principle, which is to invest for the long term. You'll be able to ride out the fluctuations in the market, as you have a macro view instead of a micro view on the markets. Trying to time the market does not give your investments time to compound, which is the last of the key principles to investing. The best way to understand compounding is to go through a worked example. If you had 1p and doubled it every single day for a whole month, what do you think it'd be worth at the end of the 30 days? Well, it'd be worth a whopping £5,368,709.12p, which is absolute mega money. Now the reason this happens is because every day you are doubling your money. So it's a new bigger pot of money, which gets doubled again and again and again. This is the same in the stock market. If you invest £1,000 and get a 10% return, then you would have £1,100. Then if you had another 10% return, you'd have £1,210. And this carries on going. Again, this comes back to time in the market and being in it for the long term, as the longer you can leave this money invested, the bigger the pot is going to grow. In the penny example, if you'd taken your money out after 20 days, you would have had £5,242.88, which is 0.09% of the total 5.3 million you could have had if you'd waited 10 more days. This is an extreme example, but the principle is the same. The longer you leave your money in the market, the better. In summary, you want to be in the market for as long as possible, to let compounding work its magic and stay unemotional when the market drops. And if you can buy the dip, see it as a sale on the investment which you were previously buying when it was going up, so it shouldn't change when it's going down. This is very much a skill, as no one likes to see their portfolio down, and if you have a lot of money invested in the market, it can be down a lot. But just trust the fact that over the long term you can ride out these fluctuations. So we've covered all the important bits about why it's important to save up for your future and why investing is going to grow your money over the long term. But how do we actually do it? Well, I'm going to talk about 3 ways you can invest for the long term. First up, we have buying stocks in companies. A stock represents a fraction of a business which can be bought or sold on different stock exchanges. There are loads of different exchanges around the world, like London and New York. Normally, the biggest companies around the world are on these exchanges, and as they're public, you can buy into them. Sometimes these companies will even pay their shareholders a dividend, which is when they distribute profits. It can be overwhelming to decide which stock is good and which stock is bad, and where to put your money. So in my opinion, the best place for most people is to invest their money into an index fund. Now, all an index fund is a collection of the biggest companies in a certain industry or location. So an S&P 500 index fund will invest a tiny bit into all the top 500 companies in the United States. This is a really good passive way to invest into the stock market, as you get lots of exposure to different companies and sectors, and it's really simple to invest into each month. Personally, I like Vanguard's funds as they're low fees, but lots of providers will offer a similar product. So how does this make you money? Well, over the long term, the value of the market and therefore the fund goes up as the businesses grow larger and larger. And given the fact you've been invested for the long term, the value of your investments will go up as well. Typically, the S&P 500 has returned about 10% per year over the long term. It's easier than ever before to invest into these funds with lots of apps on your phone to do so. This is the cheapest way to invest, and you can start with a few pounds and watch it grow. Personally, I use Freetrade and Hargreaves Lansdown. I will include some links in the description if you want to check them out. Next up, we have my favourite investment, which is property, and this is really simple to understand. You put a deposit down on a property and get a mortgage, typically a 25% deposit on a buy-to-let, and then rent it out to a tenant each month. You will pay off your overheads, your mortgage, letting agency fees and insurances, and any money left over is your cash flow, which is your profit each month. Along with this, as house prices go up over the long term, your asset is worth more, and inflation will be paying down your debt for you as well. So property really is a good investment, and my channel is centered around property, so please check out some more of my videos if you're interested. Finally, we have the hot topic at the moment, which is crypto. Now, this is a really speculative asset. I would not recommend beginners to invest into it, but once you understand it more and are happy with the risk, it makes sense to me for you to have some of your portfolio in crypto, but it's very risky, so you have to be prepared for it. With anything I say in this video, please make sure you go away and do your own research and make an educated decision on it before you part with your hard-earned cash. I thought I would mention crypto as it's an asset class I have exposure to, but it's not for everyone, which is understandable, but the option is there. I hope you guys have enjoyed learning about why it's so important to save and invest money now. If you are interested in property related stuff, please check out my video on why houses are so expensive in 2021. Do not forget to subscribe, and I'll see you guys in the next video. Cheers.